$500 a month can cover a car payment, a typical grocery bill, or your basic utilities. Earning that money usually requires clocking in, but dividend investing allows you to generate that exact cash flow without trading your time for labor. To get there, you need a highly specific plan. We are going to map out a step-by-step blueprint that calculates your required capital, outlines a specific ETF allocation strategy, and identifies the single brokerage setting you have to switch on to make this work. You only need two things to execute this strategy today: an open funded brokerage account and a committed monthly contribution budget. The dollar amount of that budget does not matter, as long as it is consistent. Crossing the $500 threshold changes your relationship with the portfolio. It is the point where theoretical growth begins to feel like a real-world tool that offsets your cost of living. Step 1 is defining the actual finish line. Earning $500 a month means your portfolio must generate exactly $6,000 in annual passive income. To find the invested money needed, use this equation. Divide your annual goal, $6,000, by your portfolio's dividend yield. At a 4% yield, you need $150,000. At 5%, the required capital drops to $120,000. Seeing a six-figure target can trigger immediate sticker shock. You do not need to deposit that entire sum on day one. Most investors build this total gradually over 5 to 10 years through monthly contributions and compound interest. Having a specific dollar target turns an abstract financial goal into a fixed calculation you can track month over month. Knowing that a higher yield lowers your capital requirement, beginners often make a mistake called yield chasing. This is where you buy risky, deteriorating assets simply because they offer massive double-digit payouts, which frequently lead to dividend cuts and capital loss. Step 2 solves this. We use a structural approach called the blend strategy, which is designed to balance capital protection with elevated cash flow. This chart illustrates the structure. Layer 1 is the foundation. 60 to 70% anchors into reliable dividend growth ETFs with histories of annual raises. The remaining 30 to 40% goes into stable, higher yield assets, increasing your average yield. Once you decide your exact percentages, you lock in 2 to 4 specific tickers. A common setup uses broad dividend growth ETFs for the foundation and select high yield funds for the boost. Combining slow growth safety with immediate high yield is a balanced architecture. It provides the stability required to manage market volatility while still moving toward a 5% target yield. Step 3 requires automating your growth. You must enable a dividend reinvestment plan, commonly known as a DRIP. Instead of taking cash, your broker automatically uses dividend payments to purchase fractional shares. Next quarter, those new shares generate dividends, buying even more shares. To activate this, navigate to the dividend settings in your brokerage account. You need to switch this routing preference away from depositing to cash and toggle it to reinvest in the security. Without this single automation setting enabled, your portfolio loses its compounding momentum. Paying out cash instead of reinvesting it can significantly extend the time it takes to reach your final income goal. Starting from zero with a target of $6,000 a year can feel overwhelming. The distance between your first deposit and the finish line is significant. Step 4 is fracturing that large annual target into progressive, highly trackable quarterly milestones. Because most dividends pay out every 3 months, quarters are your natural checkpoints. Watch how this scales. Your first goal in year 1 is generating just $50 a quarter. By year 2, active DRIP compounding scales this to $150. By year 3, targeting $300 makes the compounding snowball visually undeniable. Tracking these quarterly micro-milestones provides an essential feedback loop. When you see your income rising every 3 months, you build the discipline to hold your assets through market cycles. The operational checklist is complete. You calculated your target capital, allocated a balanced ETF blend, enabled dividend reinvestment, and set up your quarterly tracking. With the machine built, the timeline comes down to your monthly deposit. If you contribute $500 a month with DRIP active, historical averages suggest you could reach your final income goal in roughly 12 to 15 years. If you scale your contributions to $1,000 a month, the math accelerates, cutting that timeline down to roughly 8 to 10 years. Log into your brokerage, identify your first foundational ETF, and execute the purchase of a single share. That action officially starts your compounding clock. Time is the only variable you cannot buy back. But executing this mathematical blueprint today ensures that your money is working to eventually buy back your time.